Hey guys, what's up? I'm Erin and welcome back to the channel. Have you heard the phrase buy the dip? That phrase made a comeback like no other in 2022. It was making headlines, it was on social media, that phrase was everywhere. So buying the dip is an investment strategy. It's a strategy where you buy an investment, a stock or an index whose price has recently declined. And the idea is that this decline represents an opportunity to buy this stock at a discount. So if you buy when the price is low, you set yourself up for success and to make money when the investment returns to its previous value or even goes higher. This type of investment strategy is really more equated with a short-term investment strategy, not really long-term. And it is a school of thought that is based on technical analysis. The idea that you can look at a chart and determine a stock's future behavior. It's also based on the belief that a stock will rise in the future. So if you buy here at the bottom of the dip, you stand to make a really great profit. More profit than if you would have delayed and waited to buy here, or more profit than if you would have bought earlier, say way back here. And the bigger the dip, the bigger the profit you stand to make. The smaller the dip, the smaller the profit. It's all based on the theory of buying low and selling high. And that's really what every investor wants to do. Now, this behavior looks an awful lot like market timing, which we all know isn't that successful. You hear over and over again how stock pickers tend to trail the markets. There's even been instances where animals, cats or monkeys, have been able to best the professional stock pickers themselves. Every year, the S&P Dow Jones Indices does a study on active versus passive management. Last year, they found that after 10 years, 85% of large cap funds underperformed the S&P 500. And after 15 years, nearly 92% are trailing the index. It is entirely possible to beat the market in any given year. Many people do actually, but it gets exponentially harder to keep that streak going, to beat the market year after year after year. That's where it becomes highly unlikely. When you're investing in this way, when you're trying to buy the dip or when you're picking individual stocks, there's really a huge element of psychology at play. Say you're investing in a stock that is starting to decline in value. A lot of investors get the attitude of, okay, I'm gonna wait for this stock to rebound and I'm gonna sell it. I just don't wanna have a loss. So I'm gonna wait for that price to get back to where I bought it. But then that stock doesn't rebound and that stock just continues to decline and decline and decline. And investors start to think, oh, I just can't stand to lose any more money. Then they sell that stock. But say that stock does turn around after the investors sold it. The price starts to increase. The investor watches this increase and they're like, I can't believe I sold. Now the price is increasing. I'm gonna wait for that investment to drop again. Then I'll buy it, then I'll make my money back, then I'll make a profit. But this time the stock doesn't decline in value. They watch that price go higher and higher, and eventually they're like, I can't sit on the sidelines anymore. I have to get back in this. They buy the stock at a higher price. In this way, they end up buying high and selling low, the opposite of what you want to do, and they tend to get back in after much of the rebound has already happened and after much of the profits have already been made. And this is why market timing is so incredibly difficult. You have to be perfect with your timing in order to win at the game. And all the while, your psychology is working against you. Then throw it on top of that we as investors tend to suffer from recency bias. When things are going poorly, we tend to think, oh, this is what's going to continue going forward. When things are going well, when stocks are up and indices are up and the market is doing great, we tend to think that that is what will continue forever. But inevitably, the market tends to ebb and flow. The market doesn't care what it did in the recent past. It's just us as people who tend to care. We're the ones who are trying to assign meaning to everything. When people talk about buying the dip, they assume that a stock's graph is going to look like this. This is a graph of the S&P 500. Long term, it goes up. Here's a graph of the Dow Jones. Long term, it goes up. Here's a graph of the NASDAQ. Long term, it goes up. We hear that all the time. Long term, the stock market goes up. But an individual stock is not reflective of the entire market. The entire market is reflective of a country's economy as a whole, its advancements in technologies, improvements in efficiencies. It's the growing economy. An individual stock is reflective of an individual company, and individual companies can have underlying problems. Individual companies can fail. A dip in a stock's price does not mean that that stock's price will inevitably turn around and reach its previous highs or go on to reach new highs in the future. Perhaps that dip is a sign of a start of a downward spiral of a failing company, or perhaps that dip is the start of stagnation that could last for years and years to come. The dip in an individual stock is very different from a dip in the overall market. They're not the same thing. I also think it's kind of important to keep perspective here. The year 2022 was really rough on the markets. We had a down year, so we had dips to buy. It's kind of a sign of the times to hear this phrase. We didn't hear the phrase buy the dip during our 13-year bull run simply because there weren't that many dips. Most things were on the up and up. Stocks were doing exceedingly well. But now, in a rough year, we're having dips that people are trying to profit off of. So it's important to know that when rough times hit, you're gonna hear these recycled phrases. But just because the market looks a little different today does not mean that you should be changing your behavior as an investor. That's kind of a reactive investment strategy. You should have a solid investment strategy for all times of the market. If you're sitting on the sidelines waiting for the market to dip or waiting for a stock to dip in price so you can buy at the perfect time at the bottom of that trough to maximize your profits, you have to keep in mind that there's an opportunity cost, as in what could your money otherwise be doing? How could you otherwise put your money to work? And that brings us to the good old dollar cost averaging. Dollar cost averaging is where you have a set amount that you invest on a regular basis. Maybe that's every 2 weeks, maybe it's once a month. It's whatever amount and whatever time frame works for you. And dollar cost averaging kind of allows you to capitalize on buy low, sell high. When you're investing when the markets are down, share prices are less, your dollars go further, you capture more shares. When share prices are up, your dollars don't go as far, you buy fewer shares. I love that dollar cost averaging removes the emotion from investing. I always like the phrase, always be invested and always be investing. That way you don't have to worry about missing the rebound when the market does inevitably rebound from its very own dips. You don't have to worry about timing the perfect bottom or the perfect top. If you could do those things, if you could be meticulous with your timing, sure, you would do better as an investor. If you could only capture the gains and miss out on the losses in the market, absolutely. But the odds of being so meticulous with your timing, being perfect with your timing, are not that great. Identifying the perfect bottom and the perfect top are not an easy feat. That is why stock pickers don't beat the market over the long run. Over the long run, it's probably better to just be dollar cost averaging and always stay in the market. So that is why when those headlines are screaming, buy the dip, maybe you just stick with your same investing philosophy. Maybe you continually invest every single paycheck and you know that eventually you will be successful with your investments. What do you guys think? Leave your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.